Hello, everyone, and thank you for attending the presentation today. My name is Andrew Kay. For those of you who don't know me, I'm one of the leaders of the retirement plan team here at Alesco. While our lives have been impacted greatly in recent days and weeks, I want to talk today about what that means for your retirement plan investments. I'll leave some time for questions at the end. If you'd like to write them in as we go, I'll do my best to address as many as possible. To start with, there are a few main points I'd like to focus on today. The first is the market volatility, or the magnitude of market movement. While it has been particularly high lately, is part of investing in the capital markets. For long-term investors, it is imperative to stay the course. We need to fight our emotions. Emotion can be an investor's worst enemy. When others are panicking, it is as important as ever to keep a level head. We'll also cover why staying invested is so important. The average investor's return is less than the mutual funds they invest in as a result of performance chasing and trying to time the markets. If you're interested in discussing your personal investments with Alesco, please reach out. Our office number is 585-586-0970. The best way to set up an appointment to speak by phone is by emailing us at the addresses you see here. They'll be on the last slide as well in case you missed them. We all know that the stock market can be volatile. However, it is important to understand not just how volatile things can be in the short run, but how reliable the returns are in the long run. Here we are looking at the rolling returns of the stock market. As we can see, the one-year returns can be quite variable. Despite this, 3 out of every 4 years, the stock market has provided positive returns. When we expand this to 5 years, there are positive returns 86% of the time, and 10 years, 95% of the time. Note that over 15 years, there have been 0 time periods where the market returns have not been positive. This is really important for us as long-term investors. Keep in mind that even if you are nearing retirement, the time horizon is still long-term. Think 10 to 15 years or more, as we hope to live many years into retirement. Many of you have heard me say before that we are in a very unusual business. When our product is expensive, people want to buy more of it. And when it's cheap, people want to buy less. Shouldn't it be the exact opposite? This is reflective of human nature, but we need to resist those emotional feelings when it comes to investing. Think back to December and how great everyone was feeling about the stock market. Investors were looking to put money in. Now, the market has entered bear market territory, which would be a much better buying opportunity, but instead investors are panicking and selling. We need to fight this feeling of fear. Warren Buffett's famous line is that in investing, you need to be fearful when others are greedy and greedy when others are fearful. In the years that I've been advising on retirement plans, what I've heard time and time again is either, I am really glad I stayed the course in 2008, or I really regret getting out of the market in 2008. So what happens when we go through bear markets? This chart shows that while these times can be stressful, they are often followed by prolonged periods of positive returns. Notice that the magnitude of the positive returns is significantly greater than the magnitude of the negative returns. This is because the market has consistently produced positive returns, despite periods of poor performance. A down market is the worst time to make a change to your investments, as once things right themselves, whenever that may be, the market will likely react very positively. On that same topic, the markets are resilient. This chart shows us various events over the past 50 years that caused investors concern. There are always reasons not to invest, and yet the markets have continued to trend upward. Do not get caught up in the fear that is induced by the media. Remember that the media is a business too. Their job is to get more viewers and readers, not make you a better investor, and fear sells much better than good news. We need to keep focused on the long-term potential of the markets. The last 2 slides focus on the risks of trying to time the market. You will always hear about the market timers that successfully get out of the market at the right time. However, what you won't hear about are the vast majority of the market timers that did this at the wrong time. This chart shows us the risk that you take if you try to time the market. On the left, you see the return of an investor that puts $1,000 into the S&P 500 index in 1990 and then leaves it alone for 29 years. That $1,000 investment grew to more than $13,000. If this investor missed just the single best day in the market over that time period, the value of their portfolio drops from $13,000 to less than $12,000. When you expand this to the best 5 days, you lose more than a third of the returns. Expanded to 15 days, you have now fallen to less than half of the return of the market over that time period. The point here is that the risk of missing the good days is not worth trying to avoid the bad days. The more challenging part is that the best days often follow the bad days, as we've seen quite dramatically the past few weeks. The other challenge with trying to time the market is that you have to be right twice. You have to know when to get out as well as when to get back in. The professionals don't do this effectively, so I strongly discourage you from trying to do that as well. Here we are looking at 3 investors. They each saved monthly at an annual rate of $10,000 from 1980 to 2019. They either invested their money into the S&P 500 or into a savings account, earning 3%. As you know from your savings accounts these days, that 3% figure seems quite high. The first person, Mr. Blue we'll call him, is our worst timer. He invests each month into a savings account, and then at each market peak, or the worst time to invest in the S&P 500, he puts all of his money into the market. He proceeds to do the same thing at each market peak. You can see he ends up with about $2.6 million. For reference, if the investor never put that money into the market and just let it grow at 3%, he would have had less than a third of this balance. So even the worst timer was better off in the market than in a savings account. Now we look at our best timer, Mr. Orange. This person invests each month into a savings account and then invests all of the money at each market bottom, or the best time to invest. You can see that he did considerably better than the worst timer at $3.8 million. But what if, like in a defined contribution retirement plan, an investor just consistently invested their money into the market regardless of the market conditions? This is our green bar, or Mr. Green, on the right. He did much better than even our best timer. This is the most important message of this whole slide deck. Do not try to be market timer when a disciplined strategy will work much better. Before we open it up to questions, let's cover what you should be doing. Focus on controlling what you can. Make sure your asset allocation, or stock and bond mix, is appropriate for you. If you are nearing retirement, you probably should not be as aggressive as someone who is many years away. Minimize your expenses. We ensure that the expenses in your retirement plans are very competitive. But it's important for those of you with outside investments like IRAs or taxable accounts that you are aware of the costs you are paying, as those can hinder your returns over time significantly. As we've covered today, make sure you stick with your strategy. Once your asset allocation is set, you should not be adjusting it based on what the markets are doing in the short term. As a reminder, Alesco is here to help with your investment-related questions and can provide guidance on which investments are appropriate for you given your personal situation. Feel free to call us or email us, and we will do our best to get back to you within 1 business day to set up a meeting. As mentioned at the beginning, the best way to set up an appointment to speak by phone is by emailing us at the addresses you see here. If we do not get to your question, please leave your contact info, and we will get back to you to address it.